The medical trader. Discipline creates freedom. Light technical analysis. Let's start with the foundation of technical analysis, the candlestick. A candle is like a snapshot of a battle between buyers and sellers. It shows where price opened, how high it went, how high it pushed, how low it dipped, and where it finally closed. The close tells you who had control at the end, and that matters a lot more than people realize. A green candle means buyers closed it higher than the open. A red candle means sellers closed it lower. Simple but powerful. Once you understand what the candle is telling you, the chart stops looking random. Now, let's talk about the wicks. The upper wick shows the highest price during the candle, how far the buyers tried to push before running out of strength. The lower wick shows how far sellers tried to push it down before buyers stepped back in. Those wicks reveal the tug of war underneath the surface, and right in the middle is the body, the open and the close, where the actual decision was made. When you combine the body and the wicks, you're not just looking at colors or shapes, you're watching behavior. You're learning who's winning the fight. This is the first step in a technical analysis. Just learning to read candles will improve your trading immediately because you're finally seeing what the market is doing instead of guessing. Next, let's talk about support and resistance. Support is a price level where buyers usually step in and defend the stock. It's a floor. Price comes down, touches it, and often bounces. Resistance is the opposite. It's a ceiling, a level where sellers usually appear and the price struggles to break through. And honestly, support and resistance is one of the simplest, most basic ways to start trading. If you're new, this is where you begin. Just learning where the important levels are. These levels matter because they show us where the real battle between buyers and sellers happen. If the price is near support, we watch how it reacts. If it's near resistance, we slow down and stay patient. Trend lines help us see the direction of the market. If the price is making higher lows, we draw a trend line underneath. That's an uptrend. If price is making lower highs, we draw it above. That's a downtrend. Trend lines don't predict the future. They simply show you the path price is currently taking. They give structure and they help you avoid trading against the trend. Once you have identified the trend, the next step is simple. Always look left. The past price action shows you where the important levels really are. And once you know those levels, the next step is choosing the right time frame. Each time frame gives you a different layer of the story. The weekly chart shows the big picture trend, the direction the river is flowing. The daily chart shows the key levels and where price reacts. And the 15-minute chart helps you fine-tune your entry. So looking left shows you the important levels, and using time frames shows you how those levels fit into the bigger picture. Put them together, and your chart suddenly becomes much clearer. And when you put all this together, candlesticks, wicks, support and resistance, trend lines, looking left, and the right time frames, something powerful happens. All these tools begin to support each other. That's called confluence. And confluence is the foundation of a high probability setup. In episode 5, that's exactly what we'll study. How multiple signals lining up can give you calm, confident entries. Now a moment of calm. Technical analysis can feel overwhelming at first, but clarity comes from consistency. The more you look at charts, the more the noise fades and the structure appears. And today's quote is from Bruce Lee. It's not a daily increase, but a daily decrease. Hack away at the unessential.